Good afternoon, ladies and gentlemen, and welcome to our class on fundamental analysis, brought to you today by LegacyFX. LegacyFX is one of the world-leading providers of Forex and CFD trading. They are a regulated provider, so if you can't access their website while you're in class, it's because they only offer trading in areas and regions in which they are licensed and regulated. Legacy offers 4 different trading platforms. You can use their web trader, which is just an online, you just put in your username and password and trade right live online. Or you can download the MetaTrader 4 platform, which is the world's leading professional software for trading. You can also use their mobile trader on your Apple or your Android for the ability to trade anywhere at any time, or to check your trades, change your trades, or do whatever you need to do. Or you can download their CRX station for the most up-to-date trading platform with a wide range of advanced features. You can use all of them, one of them, none of them. You decide how you want to trade. But whatever you do, you'll find out that their platforms are dynamic and user-friendly and fully customizable. You can make them fit what you want them to be, because Legacy makes trading simple. They offer focused and personalized services that make trading logical. LegacyFX cuts through the excessive jargon and provides financial content in a language that is comprehensive to all. And they'll educate you. They have a large array of educational materials. They have their Advanced Trading Academy. They have materials, videos, webinars, live classes, seminars for whether you're a novice and a beginner, or you're a professional or an experienced trader. They offer a full array of deposit and withdrawal methods, all based on the region and country in which you are trading. They have their LegacyFX Pro Rewards program, and they offer incredible security so your account and your personal data and your trading is always safe, and their Dynamic Trading Academy. Now, because Legacy is a regulated provider, I am required to give you a risk warning. So I'm going to read the first paragraph, and I would appreciate it very much if you could read the rest that's on your screen. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 76% of retail investors' accounts lose money when spread betting or trading CFDs with Legacy. You should consider whether you understand how spread bets and CFDs work, and whether you can afford to take the high risk of losing your money. LegacyFX provides an execution-only service, and therefore any market analysis, opinion, commentary, or other information which is provided during this webinar is for educational purposes only, and is not intended to be a professional recommendation or construed as advice. Now, today's class is going to be recorded. And if you want to see a recorded version of today's class, you can do so by using the same link you used to attend this class in about 24 hours. Or once investing.com has had time to edit it and clean it up, you'll be able to find it on the investing.com website under the Education tab, and then look for Webinars on Demand. And in fact, there you can see all the classes we've ever offered over the last 7 years. And you can pick and choose which ones you want to watch, and watch them at your convenience. So let's get started talking about fundamental analysis. And in this day and age, it is more important and appropriate that we spend, or that we look at, how things like the coronavirus and the volatility caused by such, and the economic problems that we're looking forward to, how all of this is affecting the markets, because this is all part of fundamental analysis as opposed to technical analysis. So technical analysis is really the study of everything and anything we put on a chart. Price movement, support and resistance, moving averages, technical indicators. On the other hand, fundamental analysis studies the core underlying elements that influence the economy of a particular entity, like a stock or a currency. and it attempts to predict price action and trends by analyzing economic indicators. Now, there are two completely different aspects of fundamental analysis. Now, they do interrelate to some degree because we have to separate technical or fundamental analysis for stocks. Okay, because stocks are almost like a country to themselves, because they have their investments, their press releases, they have their quarterly statements, they have their profit, they have their sales numbers, and you would analyze those different than you would the jobs report, manufacturing reports, inflation reports. Although they all flow back to affect the value of a stock, they more directly affect the currency of a country or gold and oil. So we have analyzing the economy, we have analyzing a particular sector of an economy, like looking at just energies or looking at agriculturals. Okay, then we have analyzing financial statements, and we also have analyzing current market valuations. So fundamental analysis can be explained as a method of estimating an asset which involves attempting to evaluate its basic value by assessing allied financial, economic, and other quantitative and qualitative factors. Fundamental analysis aims at studying everything which affects the value of a security, including macroeconomic factors such as the overall economy and industry conditions, and company-specific factors, including financial conditions and management. So why, when you see in the financial paper, this CEO has been convicted or charged, or this CEO steps down, or this one announces retirement, why does that affect it? Because the management of a corporation has an effect on the value of the shares of that corporation. Now, one of the funny things about the stock market is that every time one person buys, another sells, and both think they are right. So this analysis method is taken as the opposite of technical analysis. As explained by Investopedia, fundamental analysis aims at using real data to evaluate the value of security. Even though most analysts use fundamental analysis to evaluate stocks, this technique can be used for almost any type of security. So the main goal of carrying out fundamental analysis is to generate a value that an investor can weigh against the current price of a security. Okay. Now, this all works if we're investors. Most of us here in this class today are short-term traders. So in a lot of cases, we're not looking at whether the inflation report is going to support the value of the dollar, and the dollar is going to go up over time, or is the US economy doing better? So will the dollar go up? We're more concerned with the market reaction in the here and now. Will this report generate volatility? Will it push the asset up? Will we get a knee-jerk reaction? Will it push the asset down? So when we're looking at incomes and earning reports, quarterly reports, a simple miss of a number, and it just depends on where the market attention is at the moment, can send a stock tumbling or skyrocketing. Okay. Now, a couple hours later or a day later, it levels it out. And to give you an example, several quarters ago, Walmart released their quarterly report. Their same store sales were all right. Their new store sales were all right. Okay. Their profit missed expectations. Their expenses were higher than expected. Now, you would have thought immediately that would have pushed down Walmart stock, but Walmart stock surged. Why? Because inside this report, we saw that their online sales had increased more than expected, and their overall online or e-commerce was doing much, much better. And since the market was so pinpoint focused on e-commerce and the growth of online trading as opposed to brick and mortar sales, it sent the stock skyrocketing. So, but that's all part of fundamental analysis. You would have not been able to get any of that out of technical analysis. So fundamental analysts can be used to illustrate, as an example mentioned ahead. Let us assume that an investor can execute fundamental analysis on the value of a bond by looking at economic factors, including interest rates and overall state of the economy, as well as information about the bond user and like potential changes in credit ratings. Okay. So this is fundamental analysis, because what you're trying to do is figure out, will that bond go up or down in value? Will the stock go up or down in value? So the goals of fundamental analysis in a stock evaluation method that uses financial and economic analysis to predict the movement of stock prices, predicting future price movements, determining fair value, management evaluation, analysis of company financial strength, and determining the company's ability to beat competitors. So the goal of fundamental analysis is to make financial forecasts, and the fundamental analysis is done on historic and present data. Okay. Now, we're not going to spend much more time talking about stocks. Okay. Because most of us here want to talk more about currencies and about commodities, especially oil and gold. So most of us aren't concerned about return on investment and intrinsic value of a share, because again, most of this helps us much better if we're looking at investing. Helps me more when I'm looking at adding things to my retirement portfolio. Okay, because I don't really care if a stock is at 142 today and I could buy it at 142.05 and I can sell it later today at 142.07. I care that it's at 142 today, and I think over the next year to two, it'll go up to 165 because it's my retirement, it's low risk. But with stocks, we want to look at earnings, income statements, balance sheets, and cash flow to determine the fair market value. We want to evaluate management, and simply analyzing a company's overall performance will not fulfill this goal. Rather, deducting peer comparison analysis is equally important. You should always question yourself before investing in a company that whether the company is a strong position to beat its competitors or not. So once again, income statements, balance sheets, cash flow, management, and competition. But what about the other markets? Now, for the national economy, fundamental analysis might focus on economic data as assessed the present and future growth of the economy. Fundamentalists do not heed the advice of random walkers and believe that markets are weak-formed efficient. By believing that prices do not accurately reflect all available information, fundamental analysis or analysts look to capitalize on perceived price discrepancies. Now, we do this by forecasting the weather of the markets. Now, we are in the midst of a very unusual situation. Okay. Globally, regionally, individual marketly. I mean, a very, very good friend of mine called me this morning and she said to me, why is the dollar down and why is the euro so high? I said to her, because over the weekend, the Federal Reserve had an emergency meeting and dropped interest rates to zero. She said, but why would that affect anything else? I said, because when interest rates fall, less foreign investment flows into the country because they would rather park their money elsewhere where they're getting higher returns on their money. But on the other hand, when we look at the time and what's going on around the world, even though the euro dollar has climbed and the euros has climbed in value, climbed out from 106, 107, 108 to as high as 114. Now the global corona emphasis is saying that the center of corona is now in Europe. Therefore, we're going to see a weakening of the euro. So even though the euro dollar went all the way up to 114, I think at the last look it was down to 111. That's a big movement for the euro. Gold, on the other hand, during this time of safe haven trading and volatility, you would think gold would be over 1650. And when I looked at gold, it was down in the 1400s. Why? Now, successful traders need to be aware of market conditions and plan accordingly. So a key concept in fundamental analysis for Forex traders is whether the underlying asset, whether it's a stock, bond, or commodity or currency pair, remains the cornerstone of how trading decisions are made for many professional retail traders. We basically say good economy, higher currency value, bad economy, lower currency value. For those who are not purely technical, performing sound fundamental and market analysis before initiating a trade can make a significant difference in the overall success of a trading position. And it is especially true for longer term position traders. For example, knowing how a currency pair may react to a major central bank decision before it's released and what the market is expecting to happen by going through the basic Forex fundamental analysis process can be very helpful to a currency trader when establishing or liquidating a position. Now, fundamental analysis is one of two methodologies we have for forecasting price. We have technical and fundamental. Okay, I don't think either one should ever be used independently of the other. Now, I'm basically a technical trader, but I'm a price action trader. I don't really deal with technical indicators at all. I deal with price patterns, support and resistance trend lines, and that's virtually it. But I always take into account what is on the economics calendar that could possibly send the market in a topsy-turvy method. And since we're short-term traders, we need to know that the jobs report is being released at 1 o'clock today, because it might create added volatility that we have to cover when we do our risk-reward ratio and when we set our stop losses. Now, basically, currency pairs tend to react sharply to the release of economic data and current geopolitical and local news events, especially when the results differ significantly from what was originally expected by a consensus of market participants. This makes performing a fundamental market analysis of economic releases and events and their effect on currency value when determining the direction of the market and the level of future exchanges. Now, fundamental analysis has traditionally been better suited for traders who operate on a longer-term time frame. The method involves analyzing a nation's overall economic strength, its interest rates, central bank monetary policy, money supply, trade and currency, and current account balances, as well as a country's overall political stability, as well as, what I didn't mention, is jobs and inflation. So nevertheless, some fundamental traders use short-term news trading strategies that generally operate right after a major economic event, central bank decision, or news of a major geopolitical event, such as war or natural disaster, or as a virus. Okay. But those are news events. News events fall under the category of fundamental analysis, but they're very, very hard to trade. But economic events also fit the category of fundamental analysis, and they are much easier to trade, and there's very good, easy strategies. Now, we can see all of this data that is due to come out by using what's called an economics calendar. Let me pop one up on a screen for us here. Okay. Now, what you're looking at is the economics calendar from investing.com. There are a zillion economics calendars out there. Most major brokers and most major Forex sites and financial sites have a calendar. Now, the fact is, most of the economic events are either released by the government or by a handful of well-respected financial survey companies. Like in the oil industry, we have Platts. In economics, we have Thomson Reuters, HSBC. Now, all of these events are rated in levels. All economic events come in what we call tiers. Like the jobs report out of the US is a critically important report, and it's rated a third top level, or 3 stars or 3 asterisks, but it's tier 3. So we have 0 tier, which is stuff that isn't rated, like a G7 meeting, a G20 summit, a UN meeting, an election. Then we go to tier 1, which is not insignificant data, but is insignificant to the trading markets. Okay, if you need to see a sub report on how many nurses are being hired, because you're in the nursing industry, that report's important to you. And because these reports are not developed or released for the financial markets, they're released by governments for the information and statistical part of a government. Okay, now that sub report on nursing is part of a much bigger report on the jobs report. So in the financial markets, we're concerned how many jobs were created, what the unemployment rate is. Okay? But we don't care if we created a zillion jobs in transportation and less jobs in nursing or in healthcare. But we do if we're a healthcare stock, we do if we're a human resource, we do if we're a hospital, but we don't in the financial markets. But the overall, what we call the headline news, can cause instant volatility in the markets, not because it's good or bad, okay? Because that's not a significant factor in short-term trading. Short-term trading is about the expectation of the market, because a jobs report, which is the U.S. non-farm payroll report, which is released the first Friday of each month, we already know what the expectation is. We already know when the economy is bad or the economy is good. Okay, and we get what we call in our economics calendar the forecast. This is the market expectation. The prices of all the assets are already been adjusted and taken into account the market expectation. It's when the report is released and is better or worse than expected. Okay, and that can have a major effect on and cause volatility in the markets. Okay, it won't cause a long-term effect, or it might have a much longer-term effect, but it's going to have that instant volatility. So like if we were expecting the US to create 225,000 jobs and only created 79,000 jobs, okay, we might see the dollar fall all the way down and then plummet right back up and then fall all the way down and plummet back. But the dollar's eventually going to find its level. But for us short-term traders, that can be good because we can trade volatility. But the calendar is fed by data feeds. These data feeds come directly from the government or from the releasing agencies. So regardless of how the calendar is set up, what the graphic designer did, what the IT guy did, what the brand did to make it look like it's unique, all the data is the same. They all come from the same agency. They're not open to other people putting things in. Okay, so keep that in mind. But whether you're going to trade from fundamentals or not, you should be looking at this calendar at least every day and constantly monitoring it when you have open positions. Because if you were trading the Indian ruble, okay, and everything was going in your favor, it was way in your favor, okay, your trade was going good, you had your stop loss come, but you didn't realize that they were releasing their inflation report. So even though you were well into the money. This inflation report came out and it missed expectations. It caused market volatility. What happened was the ruble fell in the opposite direction of your trade, fell all the way down. You got stopped out. You ended up with a losing trade. But an hour and a half later, the ruble was back up to where you were back in the money. But because you didn't realize something was going to cause volatility, you didn't move your stop loss, or you didn't close out your position ahead of time because you didn't know that something was happening. So looking at and understanding the fundamentals are very, very important, and using an economics calendar can be a key to making sure successful trades stay successful and that you don't end up losing money when you shouldn't have. So regardless of which analysis method best fits your trading plan, research remains a key element in successful fundamental or Forex, technical Forex trading. And most traders find a working knowledge of both analytic methods are beneficial. Now, for most useful tools for fundamental analysis consists of the economics calendar, the financial news media, and historic fundamental data. The economic calendar informs the trader on a scheduled time and a date of the release of major and minor economic events that can have an effect on the nation's currency. But also, every trader should understand how one report rolls into the other and how all of these affect, and ultimately what it affects is tells you what the economy is and affects what the central bank action is. And every piece of this data flows together. And too many people take them as individual pieces without looking at the whole pie. Like in the US, and the US dollar and the US economy affects almost every asset. But we have, just in housing, we have several housing reports. We have new home sales. We have building permit releases. Okay. We have existing home sales. We have, and I forget the other two reports. Oh, we have the mortgage report. Okay. All of this wraps together because new home sales don't count until the home is closed. So if you're buying a new home that's got to be constructed, that is not even going to count until it's finished being construction, you bought it. But when the builder pulls that building permit, you can tell by how many building permits have been pulled over, because that means the construction is going to start. Mortgages, okay, tell you how many people then applied for a mortgage, and then new home sales tell you when the house is closed. Now, you can evaluate that because that affects the overall housing market, it affects the value of the dollar, which affects shares like at Home Depot, Walmart, Target. Because the housing market is bad, people aren't buying stuff to fix up their house or DIY. So all of it rolls together, and you have to know how these pieces fit together. It can help you predict what's happening. Just like we have the manufacturing report. Well, in the manufacturing report is the jobs that were created or people hired in the manufacturing industry. Then that rolls over to the ADP report, which is the automated data processing report, which is the biggest payroll processor in the US. And then that rolls over to the jobs report. All of that comes out at separate times, but they all help predict what the ultimate report's going to be and how the economy is. And knowing what one is and why it affects the others helps you predict what's going to happen with the other report. So some of the major fundamental analysis indicators used by currency traders to determine the overall strength of a country's economy and potential exchange rate forecasts include gross domestic product, known as GDP, employment data, known as the jobs report in the US. In Australia, it's just a jobs report. In the UK, it's called the, oh, where's my brain? The claimant count. Okay. Then we have retail sales. We have factory reports. We have inflation numbers, which is consumer price index. So let's take a look at some of the key fundamental indicators that affect the market. Now, I mentioned jobs report. Employment reports, including the unemployment rate, the number of claimants or jobless individuals applying for services, payroll levels, and other job-related forecasts, all fit into the jobs report. Then we have trade balance. It's the difference between a country's imports and exports. What's it tell you when imports are going up and exports are going down? It gives our economy in a weird shape. That means we're bringing in more from China, but we're selling less to the rest of the world or any other country. A deficit would mean a country is importing more than exporting, while a surplus indicates more exports than imports. Okay. Very few major countries should have a major imbalance in this. Then we have current account. It's one of the two components of the nation's balance of payments. The current account is the balance of trade and the net cash transfers for a country. So if we go back to imports and exports and then roll over to current account, imports and exports also, if you're importing stuff, you're paying with your currency into other currencies. In the old days, you were converting dollars into whatever currency you had to buy the asset for. And then imports, you're using your dollars and converting it back. So it's a flow of money back and forth. Current account is actually the value of a country's foreign assets. Okay. Are foreign people investing in buying U.S. stuff or selling U.S. stuff? Is the money draining out of the U.S. or draining into the U.S.? Because foreign investment is much more important than how many jobs you actually have. And then we have GDP as changes in a nation's gross domestic product. It's how big our economy or the individual country's economy is growing. Are you growing? Are you producing more goods? Your factories working better? Are your people more employed? So a sharp increase in GDP indicates strength in the economy that could stimulate appreciation of its currency, especially if the market participants anticipates a possible interest rate hike. Because ultimately it all comes back to interest rates. Now, what's happened with coronavirus? It's totally fundamental when you look at oil. When the economies are shutting down around the globe, we're going to be burning less fuel. Less fuel means less demand for oil, whether it's trucks on the road, people going to work, whatever it is. Factories are being closed down. People are being laid off. People are being sent home. Less demand for oil, lower prices of oil. Why in the U.S. over the last couple of years, with oil prices being as low as they were, we weren't as concerned with inflation, because what happened was you weren't even that concerned with taxes, because when you're filling up your car at the gas station, instead of costing you $100, which it did for a long time, it's only costing you $80 because the price of fuel is less. That's like putting a $20 raise in your pocket, although you didn't get any more money. So then we have consumer inflation, consumer price index. There's a big problem if prices in the store are going up faster than your paycheck. So when inflation is starting to outpace everything else, that means prices are going up, because we have this wheel turning in a cycle, and that cycle has to keep continuing. So the mandate of most central banks is to maintain inflation at 2%, maintain full jobs. And they do this by raising and lowering interest rates. And so this is ultimately important. Then we have producers price index. PPI helps us foresee how inflation is affecting the manufacturer, because if his goods are costing him more to get to manufacture something, he's eventually going to have to pass that price increase forward. And we have the purchasing managers index. We have the commodities price index. All of these are factors that affect the central bank monetary policy. So each major economy has a central bank that typically manages its currency, its benchmark interest rates, and money supply. Central bank activity and speeches by central bank officials are closely watched by fundamental traders for clues about future monetary positions. Now, again, if we look and see exactly what happened last week and yesterday with the Federal Reserve dropped interest rates down to 0.50. Now, we've been steadily increasing interest rates as the economy had gotten better. Because when the economy is bad, you reduce interest rates, so businesses will invest more money, or they'll borrow more money at a lower price for a capital expansion. Okay. When business is doing well, the economy is doing well, you raise interest rates because you want to stop inflation, but because businesses are making profit, they still do capital investments and they still expand. Okay. It's a balancing act. But because of coronavirus, which is having a direct effect on the stock market because we have a lot of people pulling the money out of the stock market out of fear. We have other people, we're not sure how this slowdown, this, no entertainment, no, stay at home stuff, all of the stuff, and we don't know how it's going to play out. So therefore, the central bank dropped its rates last week to help keep businesses borrowing money and keep them expanding, or buying and investing, buying more equipment, so that they would hopefully create more jobs, even though they can't create more jobs at the moment because people are going to be quarantined or homebound. Okay? But they want businesses not to be freaking out because they're losing sales and they're going down. Okay? So they put more money into the economy by dropping interest rates. But then over the weekend, they had an emergency meeting in which they say it happened in 2008. I don't remember ever emergency meeting. And they dropped the rates to zero. Well, that means foreign money is draining out of the US dollar really quickly. Because if you have $1 billion, like Apple's got, billions of dollars floating around, well, you're not going to leave it in the bank earning no money. You're going to leave it in the bank, even if you're earning 0.25% somewhere. That's a lot of money on $1 billion in cash. So what happens is money drains out of the US. But at the same point, businesses can feel comfortable borrowing money to keep themselves stable or to invest in other things because they're borrowing at virtually no interest rates. So all of this affects the value of the dollar. And this is crucially important when it comes to trading in the financial markets and the Forex markets. So we have central banks which control credit, interest rates, exchange rates, and assets. Now, how does this emergency drop also help the individuals? Okay, emergency drop like we had down to zero means that a lot of us who have adjustable mortgages means our mortgages not going to adjust this month or next month, but in 90 days, 6 months, our mortgage rate will drop a few dollars. A lot of us have credit cards that are based on Prime Plus. Prime is the major interest rate, and you might have Prime plus 6 on your credit card. Well, if Prime dropped down 0.5 of a point, that means your credit card, your credit on your debt also went down for an individual person. So central bank policy is very important. They also have one other tool, that's asset purchase and quantitative easing. Ben Bernanke actually was the first, and I think he was the developer of quantitative easing, where they go in and they buy up bonds and other debts into the market, and the government buys them to give more cash into the banks who can then loan more money. Okay. And then we have asset purchase, buying up debt, buying up bonds, buying up junk, all these kind of things, which the central bank will now consider, again, to help keep the economy from crashing due to the virus. So then we come to geopolitical events, and they're affected by wars. And every time we see something happen in the Middle East, we see the price of oil go up. They're affected by elections. So what do we see right now? We have, the 2021, the next election coming up in the US very shortly. We have major power shifts and power changes, and then we have natural disasters. And the virus falls under natural disasters. When we have hurricanes, earthquakes, tsunami. Okay. And this shifts what we call market sentiment. It makes us risk averse or gives us risk appetite. And so, as I mentioned, trading the news is quite difficult because you don't know exactly how it's going to affect the markets. News headlines from like the virus. You don't know exactly how it's going to affect the markets. You don't know how old it is or how fresh it is. And you don't know for sure what assets going to trade. Okay. I'm not a big advocate of trading the news. It's just very, very difficult because volatilities, but there's all kinds of strategies out there for volatility strategies involve the purchase and sale of options. There's so many things you can do. You can hedge your currency pairs, buy the currency you think is going to go up, buy several currencies against each other. but it takes a more knowledgeable trader because you have to know where to put your stop loss, where to put your take profit. And if you're using very highly leveraged trades, then it's very risky scenario. So that's it for us today on fundamental analysis. And I hope you got a very beginning point. There's a lot you have to learn. And if you want to learn any more about it, go to LegacyFX and go to their education center. They have webinars, seminars on each of the financial outcomes. They have seminars on what the currencies are affecting and how the markets are being affected right now by coronavirus and what assets you should be looking at trading at the moment. So thank you very much for joining us, and we'll talk to you again real soon. Have a good afternoon now. Bye.